Kalyan Jewellers reported an impressive 37% YoY increase in revenue, totaling 6,065 crores rupees, outperforming last year's 4,415 crores rupees but slightly exceeding the expected 5,970 crores rupees. However, EBITDA rose only by 4% to 327 crores rupees compared to the forecasted 408 crores rupees, while the EBITDA margin fell from 7.1% last year to 5.4%, underperforming the expected 7%. Net profit took a 3.3% hit, standing at 130 crores rupees, below the projected 198 crores rupees. The margin compression was a significant factor impacting net profit. Kalyan Jewellers has a market capitalization of 69,376 crores rupees. The company designs and retails gold and diamond jewelry, maintaining a leading position in India. Recently, pressure on margins emerged due to a drop in gold prices. This forced the company to sell inventory based on updated lower prices, despite having bought gold at higher rates. Such pricing mismatches should stabilize by the next quarter, potentially improving margins. Kalyan's position as one of India's top 5 gold jewelry retailers solidifies its influence in the market. Valuation-wise, Kalyan Jewellers trades at a lofty PE ratio of 110, significantly above the sector median and market leader Titan. Historically, Kalyan's valuation has shown upward momentum, indicating investor confidence despite recent challenges. Compared to Titan's stable valuation, Kalyan's higher PE demands substantial growth to justify its premium. The stock appears expensive, and this valuation needs to be analyzed critically, especially when margins are under pressure and profitability is volatile. The company's sales growth over the last 5 years has compounded at 14%, with recent TTM sales growth touching 30%. Profit growth is even more dramatic, with a 5-year CAGR of 176% and TTM growth of 29%. However, this needs to be considered in the context of prior years, where performance was inconsistent, and the company even posted losses. While recent numbers are promising, Kalyan's historical volatility suggests caution. Consistent profitability and sales growth are crucial metrics to watch going forward. From a technical analysis perspective, Kalyan Jewellers is currently respecting a long-term ascending trendline, providing robust support around the 650 rupees to 670 rupees range. The stock's recent pullback after touching highs of 786 rupees could be a healthy correction. Volume patterns suggest active buying near this support zone, reinforcing the trend's strength. As long as the stock holds this trendline, the bullish momentum remains intact, but a breach could signal a trend reversal, warranting close monitoring. Pi Industries delivered a strong performance in Q2 with revenue climbing 4.9% YoY to 2,221 crores rupees, though it fell short of the estimate of 2,297 crores rupees. Net profit rose 6% to 508.2 crores rupees, beating the expected 474 crores rupees, indicating efficient cost management. EBITDA increased by 14% to 628.2 crores rupees, outpacing the forecasted 638 crores rupees, and the EBITDA margin improved to 28.3%, exceeding the estimate of 27.8%. The higher profitability metrics demonstrate operational efficiency, even if revenue growth came in below projections. With a market capitalization of 68,131 crores rupees, Pi Industries is a leader in the agrochemicals sector. It has a well-diversified business model, focusing on custom synthesis manufacturing, CSM, and domestic formulations. The CSM segment, which caters to global agrochemical giants, drives significant revenue, while domestic sales add a stable foundation. Pi Industries has state-of-the-art manufacturing facilities and a robust R&D pipeline, positioning the company to meet growing demands in the agrochemical and specialty chemical markets both domestically and internationally. Pi Industries trades at a price-to-earnings (PE) ratio of 39, which is on the lower side compared to its historical average. The median PE over the past 5 years is around 47, indicating that the current valuation is relatively attractive for long-term investors. Given the company's strong fundamentals and its consistent market position, this lower valuation could present an opportunity. However, investors should remain cautious about broader market conditions and how they may impact earnings expectations moving forward. The company's growth trajectory has been impressive, with compounded sales growth of 22% over the last 5 years and net profit growth of 33% in the same period. The profit growth has shown consistency, and the company has managed to deliver robust performance even in challenging market environments. Recent TTM profit growth of 29% further reinforces its stability. The focus on high-margin custom synthesis services and expansion into new chemical verticals promises continued growth momentum. Analyzing the technical chart, PI Industries has been trading within a strong range, with critical support around the 4,000 rupee mark. This level has consistently acted as a buying zone, helping the stock maintain an upward trend. On the higher end, resistance is visible around 4,800 rupees, and a breakout above this level could trigger further upside. The stock's overall trend remains bullish, with volume support validating upward movements. Investors should watch these levels closely for potential entry or exit signals. Torrent Power's Q2 results were disappointing, with net profit falling 9% YoY to 495.72 crores rupees compared to 542.55 crores rupees last year. Revenue grew modestly by 3.1% to 7,175.81 crores rupees, slightly up from 6,960.92 crores rupees, but this growth failed to translate into profitability. EBITDA decreased by 1.2% to 1,207.31 crores rupees, and the EBITDA margin shrank from 18.8% to 16.8%, signaling rising cost pressures. Overall, the earnings report highlights the challenges the company is facing, with profitability coming under significant strain. Torrent Power, with a market capitalization of 78,850 crores rupees, is one of India's leading integrated power utilities, engaged in generation, transmission, and distribution. The company operates across multiple states, including Gujarat, Maharashtra, and Uttar Pradesh, with a focus on both renewable and non-renewable energy sources. The business model emphasizes operational efficiency and strategic acquisitions, yet the company is currently dealing with sector-wide challenges, such as fluctuating power demand and regulatory hurdles, impacting margins and overall profitability. Torrent Power's stock is trading at a PE ratio of 34.5, which is relatively high compared to its historical average. Over the past few years, the stock's valuation has expanded, reflecting increased investor optimism. However, given the recent dip in profit and margin contraction, this elevated valuation may seem unjustified. The premium valuation indicates that any further weakness in earnings could pressure the stock. Investors should weigh the risks of this higher PE against potential long-term growth opportunities in the power sector. The company's compounded sales growth over the last 5 years stands at 16%, while net profit growth is at a lower 15%, indicating decent but not extraordinary performance. While there have been periods of strong financial gains, Torrent Power has also experienced inconsistent profit margins. For instance, profit growth has fluctuated significantly, highlighting a lack of consistency. This mixed growth performance is something that investors should consider, especially in light of the unpredictable energy market. On the technical front, Torrent Power had been respecting a robust ascending trendline, providing steady support. However, following the weak Q2 results, the stock has broken below this trendline, signaling potential further downside. The breach of this crucial support level indicates that bearish pressure is likely to persist. Investors should watch for the stock's ability to find new support and stabilize, but for now, the technical breakdown suggests caution. A sustained rebound would be necessary to regain bullish momentum. This analysis is for educational purposes only and should not be considered investment advice. Investors are advised to do their own research and consult with financial experts before making any decisions.